episode of DigiJanus Vantage Point. This is a show where we talk about how the financial industry is being transformed. On today's show, we are specifically focusing on how the wealth management industry is being transformed or disrupted by the fintech players that we have. On today's show, I have Mike Kruger, the CEO of Autumn, a financial wellness app from Singapore. We have Sam Ree, who is the founder, CIO, and Chief Strategy Officer of Endowers, a platform again from Singapore. And we have also joined by Anurag Garg, who is from Nivesh.com, an investing platform that takes a very unique approach to investing from India. Let's get started. Mike, why don't we get started with you on how you and Autumn are disrupting wealth management in Singapore?
Sure. Okay. So I'd just like to start off by saying I don't think Autumn is really disrupting in terms of destroying the business or taking over, eating the business of other companies in the wealth management space. I think what I would rather position Autumn as something that is we are doing things differently, complementary, working with others rather than disrupting. So as the starting point, the kind of things that we're doing differently, there's the kind of three main things we're doing. So first of all, we're providing financial planning without the sales pitch. Yeah. So traditional providers of financial planning tend to get their revenue from selling wealth products. However, what we've seen is that this leads to misalignment of financial incentives. And so no matter how well-intentioned our relationship managers are or advisors are, inevitably that there is a tendency, just because of human psychology, for people trying to meet the KPIs to sell products that may not entirely be in the best interest of the customer. Or at least that's the perception of the customer. And so customers have a feeling that maybe they're being taken advantage of by the advisors, and that leads to fear and distrust, which means they're less likely to take the advice or the financial planning if they receive it. So first of all, we do financial planning without the sales pitch. Secondly, what we're doing is when it comes to planning, we help people understand the impact that their lifestyle choices have on their future costs of health, their longevity, the quality of life, and the cost of healthcare. Because as you know, your lifestyle choices, particularly around exercise and fitness and nutrition and sleep and stress management and these sorts of things, can have a huge impact on your health and the likelihood of developing chronic disease in future. And unless you take your lifestyle choices and your health into consideration, your health costs could completely blow your retirement plans out of the water. So you need to include lifestyle and health considerations into your planning for the future. So we're really doing a holistic planning. The third thing is what we're doing is we're providing recommendations and considerations from an open marketplace. So rather than having an exclusive set of partners providing products and services which we recommend, we take the entirety of the kind of products and services that are available to our customers and make recommendations on that basis. So our customer has peace of mind that we have considered everything and they don't have to go away and do their own research. So we're saving them time, we're giving them peace of mind, and ultimately really inspiring them to take action on those plans. So those are the three aspects.
Thank you. So the app not only takes care of your health, but the health of your finances too, in a very unbiased and non-salesy way. Thank you so much for that, Mike. Sam, let me come to you because you have created quite a buzz in Singapore with Endowers, and I'm a customer. I meet so many people who are customers of Endowers, and they love the platform. So, what has led to this popularity of Endowers? And what are you guys doing differently?
Well, it's great to be here, Alex, and thank you for inviting me. And it's a great question. I guess the biggest, reason why people resonate with the mission and the work of Endowers is mostly because we try to solve a pain point that is very much real. It's something that we've all experienced as individuals trying to save and invest our own money here in Singapore and across Asia. And it's the pain of having to pay too much fees. The fact that we don't, it's difficult to invest well, because there aren't products that we know are out there, but doesn't seem to be available for us. And we don't receive the kind of advice that we feel is going to really help us. Many people confess that they don't feel that they know enough, or they have enough tools or information or knowledge or education for that matter to make the right decisions that's going to help them build wealth for the long term, secure their financial future, and be prepared for really important issues like retirement, which is, what we feel the biggest generational challenge we face as a society. So Endowers is set up just to increase the chances of success for individuals in all of these areas. So the things that set us apart, and we are, unlike Mike's point, we are a little bit more disruptive, and we do go head on because we're not a B2B or B2B2C solution. We are a direct to consumer solution. We are trying to help the individual retail investor get access to great products and solutions and tools that will give them better success. We want to give them advice in a digital platform with great content that will help them reach their goals earlier and in a more personally suitable manner. Give them a wonderful experience on that digital platform as well. So I think what we consider the most important thing, the three pillars of success in wealth, we believe is advice, access, and cost, especially here in Singapore and across Asia. And we're trying to solve those three big problems. So last thing first, we want to be fee only because that is where the world is headed. We don't want this complicated structure of people, taking different fees and commissions and kickbacks. And there's so many names for it. It's just not even funny. Retrocession fees, trailer fees, whatever you want to call it. We don't keep any of it. We give it all back to the customer because they don't deserve to be paying that. So we're a fee only provider of services because we only want to get paid by the client who we serve so that we can always do what's in the best interest of the client. So we're completely aligned to their best interest. We're independent. So we can give independent advice. It's not biased. We're institutional way of investing. So like a sovereign wealth fund, we are empowering the individual to make better choices. And we're actually being holistic as well, which is really important, managing all of your wealth. So we're the first digital advisor to span both private wealth and public pension savings, which is CPF and SRS here in Singapore. So you can actually manage all of your wealth seamlessly in a single app in a holistic manner, which is really important for you so that you can succeed.
Thank you, Sam, for that. And your message has obviously resonated with a lot of customers. You have just hit $1 billion in AUM a few months back. So that is very impressive. Now, Anurag, we want to come to you because we are really excited to have you as you are targeting a really big opportunity to take wealth management to 195 million households. You have been listed as a wealth tech innovator in the Wealth 100 list. So, what are you doing differently and how are you disrupting wealth management?
Thank you, Laksh. Thank you for inviting me here. Really great to be here. So it's a known fact that penetration of financial products in India is very, very poor. Only about 2 to 3% of Indian population is invested. And there are two primary reasons. One is lack of awareness and lack of access. Right. So I believe access is very, very important. And then Indian society is also we trust deficit in terms of investing in financial products. So typically, you would have read, a lot of scams have happened in terms of money being taken away in the form of chit funds. So for us, when we looked at the entire market, there were two important things. One, how to make sure that you provide independent advice. How do you make sure that you're not, giving a wrong product to the customer? Because if these investment journeys are very long, right? Person has to sustain on the investment journey for 7 years, 10 years. And if you give a wrong product and his experience is not good, they'll basically terminate that journey and stop investing early on. So we built the entire model around how to curate the right product, and only give what is required for a particular customer, and that's a big challenge because when you're talking of mass market, people really don't understand concepts like risk, right? So we had to keep things very simple and in local language. Again, English is not really understood, so that's another important factor that why penetration has been so low. So we took care of all of that in the platform. And then second was distribution, right? So the choice was between a direct to customer versus a B2B2C approach. And direct to customer, there are already many platforms, and they're able to get to again to the top 3-4% of the population. So we took a distributor-led approach. There are millions of individual distributors who have been selling financial products in different forms and shapes all over India, but they were also offline, right? And they were struggling because they were offline, so they were able to get to certain customer base, but not able to grow beyond that. So we said, why not you come and work with us as partners? So it's a mutually win-win proposition, right? You provide contemporary technology experience to your customers. They get access to all the best products, and in turn, you grow your own business. So it's really working out well. The model has really worked well for us so far. We're seeing great traction, and particularly pandemic kind of situation has helped us to grow further. So that's just what our model is all about.
Thank you, Anurag, for that. And it is really insightful that how wealth management works differently from different perspectives in India and within Singapore as well. Now, that brings me to the next question is why are banks not doing what you guys are doing today? So I will pick Sam to go first on this. So Sam, there are so many big banks. Why are they not going and offering a fee-only platform and refunding trailer fees?
Yeah, great question. I think this is something that is asked very often, and it's not an easy question to answer because I'm not in their shoes, so I can't speak for them. But I think the most common answer that people put forward, and I think it's the right one, is that fundamentally they are what's called incumbent players. They own the client and the business of the client. It's a highly profitable business, the business of wealth. So they have to start by cannibalizing their own business because they're the incumbent players. There's a lot of inertia not to change what is working for any institution, whether it's financial or otherwise. So that inertia is something that works against them. And it's interesting because we've gone to some of these banks and, we meet some of their digital strategy guys, digital guys, or there's a strategy guy, or there's a, somebody who is in the CEO's office. And they come to us because endowers is interesting, it's different, and it's exciting. And so they want to learn, but also see if there's ways we can partner up. And one of the most obvious ones is CPF. We're the first and only digital advisor for CPF, approved by the CPF board and the government. No one has actually built a technology stack purpose-built to solve the CPF investing. We're the only ones that did that when there was nothing available. It was a completely offline experience. It took 2 weeks to even open an account, and we make that a 5-minute experience, and you can invest your CPF immediately. We can pull the money out, unlike cash, where you have to deposit the money and transfer it over. So it's a seamless process. But we had to spend 2 years building a purpose-built tech stack, spend millions of dollars and hire a lot of engineers to build that in-house because there's nothing out there. There's no B2B robo solution out there that you can take off the rack and do this. So without any possibility that the government was going to guarantee us an approval. So we had to take a risk, and only a startup can do that. We have to go for something that is not there in existence and create something out of nothing. Luckily, we did get approval, and we're off to the races, obviously. Now everybody wants to do it too. But if you build the tech stack to just do cash, and SRS maybe, but never really thought through how you do the CPF investing process within the existing frameworks, which is very complicated, then you're not going to do it. DBS, which is the biggest bank, they have the people, they have the resources, they have the money, they have the technology, they have all the accounts, and they're an agent bank of CPF, does not have an end-to-end CPF investing technology stack, which is phenomenal, which is crazy for me. But it's an opportunity for people like endowers because we can go in there because they don't see that opportunity and take it away from them.
Oh, that is a really insightful answer and a very nice example. Anurag, we'll come first to you and then we'll go to Mike because there is some really interesting questions I have for Mike there. Anurag, why are banks not taking this via these advisors to the tier 2, tier 3 cities and helping customers understand what's in there?
So to me, it's a question of the DNA of the organization. Right? So banks, for them, the core business is not really wealth management. It comes number 3, number 4 in priority. they have been focusing on their core business, like raising deposits, lending money, and then other high-yielding products like insurance. So the entire incentive system is oriented towards how we can make more money in the short term rather than over long term. While products like mutual funds, they have lower margins, trailer commission kind of system where you make money when customer is with you for many years. You don't really make money early on with the customer. So banks have focused more on transactional products where they can earn money, show better margins in the ongoing quarter, and then comes the question of technology. Right? You need to build a technology from grounds up. You really can't just do patchwork to the existing system and hope that it will work. So most of our customers already had bank accounts, but they never invested with their existing banks. Instead, they chose to come to us. So because of different benefits that we offer, for example, independent advice, multiple products, ability to see the right product for their requirements, for their risk profile. So all of that is working well. While banks will take time to build something like that.
Thank you. That is a very insightful answer. Now, Mike, in this aspect, you are the most interesting guest I have my eye on, because Autumn app was, spun out of SC Ventures. So there was an SC Standard Chartered part to it as well. Why don't you take us through the journey of how it was conceptualized and why was it spun off rather than being incorporated within the bank?
Yeah, so this is kind of related to your question to the others, which is about why aren't banks doing this already?
Yes.
And my answer to that one would be banks want to be doing this. They can see is where the future is going. But similar to what the answers that Sam gave, there's a lot of heritage there. And whether that's about the existing revenue structures of the banking industry, or whether it's having investments in technology or in relationship managers and agents, it's very expensive for them to switch to different models. And culturally, obviously, banks are by tendency to be very risk focused, very defensive. They have to report to the regulator, as opposed to a fintechs, which are much more about vision and opportunity. And so culturally, this is a very different mindset and a cadence. But banks are increasingly getting into this space. And SC Ventures is a good example of how Standard Chartered has set up an entirely new vehicle to create the opportunity, a way to explore different business opportunities. So Autumn, the genesis of Autumn was the bank identified a lot of people fail to plan for retirement and end up much worse off than otherwise that they have to be. A lot of people forego a lot of returns because they just don't invest because of fear and distrust of the financial industry and lack of access to the kind of products that they think give the returns that they need. So that was the genesis. The bank saw something needed to be done. There was an opportunity to serve customers better. They wanted to explore a different way of doing business, but they found it was difficult to do within the bank, within the standard operating structures. So that's why SC Ventures was set up and why Autumn was spun out of SC Ventures, to have this freedom to explore a different way of doing business that wasn't part of normal operations, didn't depend on banking systems, wasn't limited by existing business processes, and had a much wider remit when it came to considering taking on risk.
Okay, so as fintechs, all of you have suggested you get the flexibility, you get the risk taking ability, but I also want to hear the other side of the coin. What are the challenges that you face because you're not a financial institution? So, Anurag, what was the first challenge you faced, or some of the challenges you faced because you are not a financial institution?
Yeah, Lakshya. So there are multiple challenges, right? First and foremost is the regulatory framework. So regulatory framework has not really caught up with what fintechs really need. So we have to still operate within the traditional regulatory framework, which is more oriented or suited towards the offline way of doing business, right? So, for example, each of our advisors still needs to take a certification for distributing mutual funds. While as a platform, we are curating the product, we are suggesting the product to the end customer. So really, because the advisor is operating within our framework, they should not be required to take an independent certification. But since the regulation requires so they are forced to take that certification, which kind of creates a friction in the scale up. Right. Second is the other regulatory framework, for example, KYC norms. Right. So still for a mutual fund, you require a fresh KYC. While customer already has a bank account where they do KYC, they have a permanent account number where for income tax purposes, but still again a fresh KYC is required, which is again a little bit of tedious process. Right. So these are the kind of things which create friction, and consumer research shows that the more friction you create, more difficult it is for a new customer to come in. Right. So when we are going to the customers who have not yet invested, and you tell them that this is what you need to do, you need to sign up on few forms, provide few more information, there is a tendency to kind of drop off. Right. So to my mind, that's the biggest challenge that we still continue to operate in. But hopefully things are changing for better. Regulators are taking note of the requirements of fintech. They're doing things. So hopefully things will improve from here on.
Thank you, Anurag. So, Sam, coming back to you now, what are some of the challenges endowers faced as an early starter in the industry?
I think there's many challenges. Obviously, we were doing things that weren't done before. And so that's always, when you're a pioneer, you're always, experiencing things that no one else has experienced before, as Mike can attest to, and Anurag as well. The biggest problem I think we faced was really just, acquiring high quality talent. The banks with the big brands have an edge on us because they can give them a high salary, starting salary, give them a fancy title, give them a good brand with a business card. And young people go for that, right? But I think we were able to get people early on who really believed in the mission and the vision of the company. And that, I think, is the most important thing when we look for people. And those talented individuals, we've really lost virtually nobody in senior leadership throughout this 4 or 5 year journey. And they're all owners of the business. And that's what's different, is we really believe in what we're doing. We're all owners of the business, which is very different from working for a big financial institution. And so I think that's the big benefit of a small startup, is that we actually have control of our own destiny and our future. And so as the company grows, I think we resolve that very quickly. The valuation of the company goes up, people see the potential, they see the validation. And at this point, we were up to about 100 people, but probably continue to grow. And we're getting really high quality people apply. And that's really what financial services is all about. It's the people, right? It's not, there's infrastructure, there's technology, there's regulations, there's a lot of things about financial services, but in the end, it's actually the people that are executing and, providing that service. So, we're really thrilled that we're getting really high quality people on board with the team these days.
We'll be defining how financial services will work, and getting good quality people is a challenge for was a challenge for endowers, and they've solved this very well. Coming to you, Mike, and now Mike, in this section of the conversation feels like an island, because we come back to him and say, okay, how does being part of SC Ventures is different than what Anurag and Sam just mentioned?
How is life different in SC Ventures? So on the topic of talent, first of all, I'd just like to thank, a shout out to firms like Endowers, because the increasing number of fintechs that are doing great work in Singapore is attracting talent to Singapore, I think making hiring much easier. So that's fantastic. And we have this unusual situation where, as part of SC Ventures, we can lend a bit of the brand from Standard Chartered. So we have the ability to attract very interesting candidates who are kind of wanting the bank focus, but also wanting a little bit of doing their own thing. And they want the freedom to go out and make a difference, make a real difference. And so we have this lovely halfway house. So that's quite exciting. Of course, through the bank, we have access to all of the bank's partners. So it's like best-in-class partners when it comes to rolling out new propositions. That's relatively easy to do, much faster. We have as a genesis, we have the culture of the bank. So right out the gate, we have bank governance, which is very heavy on one hand, but on the other, it means that we have bank grade data security and privacy controls in place. So for customers, we hold the data for customers just as securely as a bank does. So that's great for customer trust. On the other hand, being part of SC Ventures means we're trying to work with fintechs and other banks in cooperation. Yeah, so companies like Endowers, for example, there's definitely a very strong role that they can play in helping people plan for the future, and we recommend those kinds of products and services where appropriate to our users. But for fintechs from the outside looking at Autumn, and they see, well, it's come out of SC Ventures. There can be a little bit of hesitance about partnering because there's a fear, oh, this is just another bank as part of the bank. Other banks need a bit of hand-holding to get across that line. But once they understand actually that we're independent and we're agnostic as to banks, that conversation changes direction quite markedly. So it's just that initial perception can be a little bit challenging. Yeah, some of the pros and cons.
Okay, and thank you for that. So, with the big name of SC Ventures come the big challenge that everybody associates you back to them, and partnerships and tie-ups become that much more difficult. Absolutely, a very valid point. So, there was something very interesting said on this panel a little while ago. It was like the bank owns the customer, so they could do all of this, but they choose not to. Now, my question to all three of you is, what if tomorrow banks decided to do this? So, what if SCB said, okay, Autumn needs to be a part of SCB now? They open up, some bank opens up equivalent of endowers, and XYZ bank in India says, you know what, Nivesh has become really successful. Let's go out there and build our own platform. So, why would customers still stay with your respected platform? So, Anurag, let's start with you.
So, my one-line answer is that banks will not be able to do it, right? So they've been trying to do it for years. So unless they take an approach like what SC has done, they really create a independent entity and they try to do it differently, the way startups are doing, then it can definitely work. But as long as banks try to do it in the similar infrastructure using the similar kind of technology stack, it's virtually difficult or impossible for them to do. So what will happen is probably they'll end up acquiring some of the startups and try to then bring in those services into their system. But once the customer has been acquired and customer is satisfied, happy with the platform, we don't see them churning out, right? Unless we goof up in our execution or in what we are doing, right? Even if the banks start offering these services, we don't see that customer will move out. And second is the market is very large, at least in India. Even if there are multiple players, banks also they start offering these services. Still, we feel there is opportunity for everyone with their own different models. And even banking is underpenetrated in India, right? Forget about wealth management. So there is scope for more banks. More banks are getting licenses, and they are coming into play. So that's what I feel that in India there is huge opportunity for everybody, and even banks, if they can, why not?
Okay. So, Anurag, that was an interesting take. Sam, I want to come to you on this one because you sit right in the middle of these two. And what happens if tomorrow there is an endowers like platform, transparent, they give back all the fee, they just charge like an access fee, and they say, yeah, come back to us. And the sign up is simpler because the customer is already on the platform for the bank. So what happens then? Will customers stick around, and why?
Yeah, no, great question. And I was the one that mentioned that the banks own the customers, but it's the phrase that the banks like to use a lot. They say that they think they own the customers, but the problem is they actually do not own the customers. They're there, but largely it was because there were no alternatives, and now there is, and that's a problem for them. And so the question that you asked Anurag earlier, why would they stay with an endowers or a fintech company? The actual question is, why would they stay with a bank? As Anurag highlighted, a bank is for lending, it's for credit cards, for your mortgage, for your deposits. But wealth is a specialized service. It's a very specific, specialized, solution. And Mike and his company is trying to solve, some parts of it. And I think there's a lot of mistrust in the banking sector when it comes to wealth because of the experience that people have had for such a long time. And that broken experience is causing mistrust, and there's definitely a pain point there. So companies like Endowers is solving that problem and pioneering a different way of solving this problem of wealth. And so that's why people are resonating with that. Now, what if a DBS or, I should have mentioned names, but any other bank come out with an exactly same service? What happens? First of all, I agree with Anurag. It's probably unlikely to happen because it means that they go to zero revenues from a very fat margin revenue business right now. They do virtually nothing, and they take 1% to 3% of someone's savings every year. It's ridiculous. It doesn't happen in any other service. It doesn't happen in any other distribution business. But banks are able to take 3% of the life savings of an individual every single year without fail, which is ridiculous. And if they take that away, then that's 3% margin business that's disappearing with no additional value add. So it's something that is very difficult for them to do, but they're going to have to do it either because guys like us are disrupting them and the supply side alternatives are appearing, or in the case of developed markets, regulations are coming in, which is removing all of this. Commissions for distributing financial products is becoming illegal, evil as well, but illegal, especially, in developed markets like the US and Europe and Australia. So that was a slip of the tongue, but it was, a Freudian slip. So I think that, banks can have that solution and, maybe copy us. They already are. There's even a bank that's named their wealth service Prosper Us, like Endow Us. So I guess, they're copying us, and that's expected, right? We don't have a trademark on these things, but what we like about people copying us is that they're copying us doing the right thing. It is the right thing to remove these trailer fees. It is the right thing to give individuals better access to amazing financial plans like Mike is doing with his company, or giving them institutional frameworks of investing like we're doing. And those are all good things, and that should be common practice. That should be best practice, and that's what every individual should be given access to.
Thank you, Sam. And Mike, coming back to you, because I want to reframe the question for you, because you're already partnering with banks. So why is a bank looking to partner with you rather than build something on their own?
I think within the next year, all of the main Singaporean banks are going to be releasing their own robos. Or they'll be doing POCs. They're all going this direction. So they already are doing this sort of stuff. What we see is increasing digitization of banking services, and particularly in the wealth space, all of the fees and margin are going out of the industry. Yeah. The only way to build a defensible business is to really own the customer. I hate that phrase, but is to be customer centric. Yeah, to really understand what the customer needs and to truly provide service. And this is the bit that banks struggle with, because traditionally customers have a fraught relationship with trust with banks. We've discussed it already. Looking at autumn customers, for example, like the average number of bank accounts that Singaporeans have in Singapore ranges between sort of 2 and 3 up to 5, depending on how old they are. So people spread their wealth across multiple institutions. They don't want to hold it all with one. There's lots of reasons for this. So no one bank has a complete view of the customer. No one bank really owns the customer. They think they do, but they just don't. It's only the kind of startups that provide a platform play which stitches together all of the different financial institutions and the services or products the customer uses that has that holistic view, that can provide a comprehensive recommendation or advice or planning. So in that regard, structurally, I think, at least with regards to autumn, banks are always going to struggle to come at this, just because they're more of a vertical than a horizontal. But in that vertical, in the wealth space, all of the banks are going there. The question is, to what extent can they be customer-centric? Can they really provide real value to the customer that stands up in comparison, transparently, with the fintechs in the industry? Like, trust is the new currency. They have to be able to demonstrate this. And for a lot of banks, they have huge investment in legacy systems, agents and advisors. It's just very expensive for them to provide this kind of advice. They're not cloud native, they're not cloud native, they're not digital first. It's very expensive. They're really going to struggle to get down the kind of price point that the fintechs can provide service at. And the customers reaping the benefits of all these fintechs coming in.
Thank you, Mike. That was an amazing answer because I do see that you are bringing a couple of different aspects into a platform, and the customers would come back and use both those aspects, and it makes that sticky and it makes it more customer centric. Now, I will shift the gears a little bit, and I want to ask you a different question. Now, we all know big tech players have helped bring a lot of disruption to the market. At the same time, these big tech players are also offering their own financial services. I am not sure if they're already offering wealth management as well, but it could be on the track, right? So, how do you look at big tech's entry into financial when they are also your enabling ecosystem or enabling infrastructure, and they are also going to be a competitor? So let's start with Sam this time. How do you look at big tech's entry into the financial world?
I knew you were coming for me, Laksh, with that question. So, yeah, I mean, it's exciting, isn't it? Because I think big tech has disrupted our lives in a meaningful way and in a positive way in generally. I think it's interesting that they're looking at finance because, fintech is the hot sector and they feel that they need to grow and they need to diversify. They need to own a different vertical of the client's, life journey. And therefore finance is something that comes up quite a lot. But what people forget is that financial services is a regulated industry. It's a licensed entity that you have to have. So it's a professional service. There's barriers to entry and there's a high cost of providing that service as a financial entity. And I think people jump into this financial services a little bit too easily. And there are things that are easier. So unfortunately, the big commercial banking services are easier to disrupt, like payments or lending or, point of sales lending, which is the hot buy now, pay later type of stuff, which is a hot sector. And then you have stock brokerage and you have wealth and everything else. But, when I was leaving Morgan Stanley after a long career, I looked at the space of financial technology and I was getting excited. But I realized there were two areas which had very little technology application, which was still very much relationship driven, which didn't have much technology disruption and had tremendous opportunities because it's huge markets. And those two, one was wealth and the other one was capital markets or investment banking type services. Now, 3-4 years have gone by and we see a lot of companies that are in this space. And I think there's major disruptions that are happening. But I think, again, you have to be both deep tech, but also deep fin. You got to know the deep layers of financial services, the pipes, as we call it, right? The middle back office stuff, the regulatory frameworks and all of those things. And it's much more complicated than, just, a delivery or, or an e-commerce platform, for example. So I think it's interesting that big tech's coming in. I have yet to see a big tech succeed in any meaningful way. So Grab launched their Grab Invest. Many big tech companies have tried to go into payments or wallets, but beyond that, there's not really much else that's happening. Or like SEA, or the Southeast Asian regional players, even China. They have the money market funds and simple deposit-like products, but they haven't, really solved the sophisticated wealth problem. And there's a reason for that. I think, this issue of trust, the licensing, the regulatory framework, but because it's a very specialized niche area, you need to have deep expertise. And I don't think big tech really has it, or they have to invest very, very heavily and for a very long time in order for them to succeed.
Sam, that was absolutely insightful. Now, Anurag, coming to you, how do you look at big tech and their entry into India? Because big tech is already offering a few financial services around payments in India. So what happens when they get into wealth management?
Yes. So already there are larger well tech players providing some financial services. So payment you already said, but even products like mutual funds. But I see that as a positive thing for us because they'll help us expand the market. right? So because of their reach, they'll be able to get in new customers. But once the customers start investing and they realize that there is a specialization which is required that Sam talked about, they'll probably come to our kind of platform, right? So they'll help us expand the market, open up the market. But since wealth kind of thing will never be again a top priority for big tech, right? It'll again remain a marginal product even within their offerings. Right? We don't see them as a serious competition, and we see that it'll just help expand the market, benefit specialized players like us.
If I have to give an award for the best 30-second answer of today's episode, that will be it, because you said they will make things easier for us. And that is the best answer I heard all afternoon. Mike, coming to you. Now, Big Tech has always been known for a great user experience, which your app also offers. And so what happens is when they take that great user experience and now they also offer financial wellness on top of it, along with mental wellness and yeah, like complete wellness. What happens then?
I think what you're talking about is inevitable. This kind of providing a wellness solution. We've seen it in the physical space and getting increasingly into the mental. But it really does come back to the points that Sam made. It's about trust, and it's about being able to comply with the regulations. And what we see big tech companies struggling with, in particular this year, is in those two areas. You look at all of the big tech companies; they're really having difficulties with trust and regulatory compliance. Traditionally, convenience has trumped those. Like, if you make it easy for people, they are willing to share any of their data, use whatever platform, so long as it makes their life easier. But over the last year or two, people are shifting. You see a real change in the way people are choosing to interact and engage with platforms. They're being more selective about the tools they use, the media that they consume, the platforms that they share data with, what they're sharing, and when they share it. I think we're seeing seismic changes in the way big tech companies operate. And just assuming that they'll be able to get into wealth management, I think is a big assumption. And I think the data is pointing like there's just too big a trust gap for them to be able to jump that. Certainly, yes, in payments, it's much more about convenience. So sure. Question about buy now, pay later, I think is controversially. I feel like buy now, pay later, the value of that is on the evil side of the equation. I think people get into debt much too quickly. They take on debts faster than they should. I feel this is perfectly aligned for a big tech play. Maybe I shouldn't be getting cheeky about that, but yeah, it really does it depends on the trust and the ability to operate in a regulated fashion. And big tech companies have shown over and over again they cannot be trusted with that.
Absolutely. That was a really nice perspective. If I have to give you a summary of what we discussed today, so the financial or legacy financials need to disrupt more, and the big techs need to be ready to be regulated more. And in the middle of these two sit fintechs like you guys, who are absolutely making things who are disrupting financial world, who are bringing really nice wealth management opportunities for millions and millions of people out there. Now, is what is the reason that there are some of these fintechs who are valued at valuations which are even more than that of banks? Is it because they have struck the balance of being disrupted and regulated? Is it because of future growth? And is it because of some reasons that most other people can't see? Now, Sam, you did mention about valuation, and you are my favorite, so I will come back to you on this.
Yeah, it's not an easy question because I think that, it's very difficult to, paint with a broad brush in terms of companies and their valuations. There are certainly companies who have very disruptive models that are very innovative, who are growing at, light scale, light speed, scale, scaling up rapidly. But then there are other guys that, I'm sure all of us would look at it and we'll be scratching our heads. Why are people paying that much? And I think it's a result of the world that we live in, the age that we're in, where liquidity is abundant. Venture capital is, flushed with money. every venture capital that I've heard of recently has raised money again with a new fund, and they're deploying it at a faster clip than ever before. And guys who traditionally weren't in this space are coming into it because there are very little returns to be had, or yields are too low. So even traditional fund managers, hedge funds, becoming much bigger players in the space, and they're, funding the companies to growth and beyond growth. Normally companies that would have IPO'd are staying private and raising even more money. So it's just abundant liquidity, and it's driving up asset prices globally, whether it's real estate, whether it's the stock market, or whether it's, crypto, or, everything is going up, right? Even commodities. So I think private companies valuations are rising. I think I can see people throwing money at certain companies. Some are justified, some are not. And only time will tell.
Absolutely. Anurag, what are you seeing in India? Why is the valuation of some of these fintechs more than that of banks?
Yeah, again, a tricky question, right? There could be various factors, behind those valuation, but what I see at a high level is, ability of a fintech to acquire customers at a rapid pace and believe that they'll be able to own the customer and, cross sell, upsell, and, increase their revenue, right, over a period. So I think that's what is driving the huge valuation, huge funding for fintechs. And again, it's skewed. It's not really uniform. Some fintechs are able to raise large amounts, some are not. So that's why it's very difficult to say, or you can't just generalize it. But I think the scale is what is driving the valuations right now.
Thank you. And Mike, coming back to you, I know you are the one who's always happy to answer questions more candidly. So, what do you think about these valuations for fintechs and what is driving this?
Yeah. Easy capital, investor over exuberance. You see the trajectory of the fintech, and most fintechs haven't been around particularly long. So it's very tempting to chart early progress off into the future, and you get multiples on returns. Whereas banks have been around for, and like Stan chart, hundreds of years, and it's very difficult to have a exponential growth from one year to the next for something that hires almost 100,000 staff. It's very difficult to shift that needle in a very short amount of time. So I think what we are seeing is that banks are increasingly setting up corporate venture capital sidecar funds with venture units as a way to leverage their existing customer base business into fintechs. And I think investors are looking for opportunities to climb into that kind of fintech space in ventures that they know are going to be well regulated and not going to get in trouble with the regulators. They're going to be on the right side of the government, particularly when you've got interesting things like crypto going on. It's quite controversial. Yeah, mixed. Easy capital over exuberance.
So we will also tread on the side of caution and not go into too many controversial questions. Now, we are just coming to the end of this panel, and I want to ask three of you one single question. If there was one thing you could change about wealth management today, what would that be? One simple, straight question. Okay, we start with Mike today.
I'd really like to shift the power imbalance more towards the customer. I'd like wealth management to be much more customer centric. I'd like the customer to have better financial literacy, to be more empowered to make decisions and to turn their plans into reality. Yeah, put the power back in the customer's court.
Thank you, Mike. So, Sam, one thing you would like to change about wealth management today?
I think banks should be banned from providing wealth services. As a joke. No, I'm just kidding.
That
but
will make
they've been entrusted with.
I was just saying that would make an excellent hook for the podcast. We will just start with that, So thank you,
Yeah,
Sam.
Wow. Okay. It's coming out punchy.
Yes.
But the reason as a joke is a joke. This is never going to happen. But the reason I say that is because, when people have given their life savings and their wealth to them. We entrusted them with our money. I have too. And it could be the retail bank, it could be a private bank, it could be a wealth provider, it could be a financial advisor. The biggest, pain point I have is that, the thing that frustrates me the most is that in Singapore, the word financial advisors has been hijacked by insurance agents, which is ridiculous. But also banks should be giving financial advice, but they don't. They push product. And, we've entrusted them with our wealth. We've trusted them with, giving us the right advice to build wealth, but they've, just not delivered. And so my proposition is not that regulations ban them from providing wealth services. To Mike's point, if consumers are well educated and they have high level of financial literacy, I think it would just be natural in like 5, 10, 15 years that people say, why did I ever go to a bank for wealth services? I go to a bank for lending, credit cards, mortgages. But for wealth services, I'm going to go to endowers. I'm going to go to, a digital wealth platform because they're better, they're easier, they're cheaper, they're on our side. They've actually made an effort to help us succeed in our, reaching our financial goals. And so I dream of a day that happens. And the one thing that is going to happen eventually, I don't know whether it's going to happen in 1 year, 3 year, 5 year, 10 years, is that the fee structures are going to have to change. That there is a sea change in global regulations where we are protecting the consumer, and Singapore and the rest of Asia has to wake up and smell the coffee and move towards that to protect the best interests of consumers, because that is what's right. That is what's in the best interest of society as a whole, so that we can get there together. And, ripping them off through high fees in just distributing or selling financial products is the wrong way to go about it.
Thank you, Sam. And I would like to take the crown of the best statement from Anurag and give it to you. That was a very, very good answer. So Anurag, that is a hard answer to follow. I don't want to be in your shoes, but what is one thing that you would like to change in wealth management today?
Well, actually, if you give me a liberty, not one, at least two things that I can talk about.
Absolutely.
Right. So one, regulatory framework I already talked about. That's really a big pain. So if all of that could change, that'll be a dream come true. Right. And second is we have to, like, for various products we have to integrate with various manufacturers, and that integration itself is a big pain. Right. We are bringing them one by one onto our platform, but spending inordinate time, energy in trying to do that. So if somehow that could be simplified, again, kind of wishful thinking. It's not going to happen, but if it could happen, that'll be really great.
Absolutely.
That one kind of goes together with the change in regulations, doesn't it? Like that open banking, open finance really needs to be led by the regulators. I'm very much looking forward to that change coming as well. Yeah.
And absolutely, I think all of you made some great points there, that an industry that is balancing disruption and regulation should absolutely be rewarded, not only by customers, but regulators. And they should absolutely come out and help you change and disrupt wealth management even more. Thank you so much, guys, for coming out today and talking on this episode of DigiJanus's Vantage Point. You gave us some really candid answers and some controversial ones. So thank you so much for that. And I wish everybody a very good afternoon. Thank you.